you doing, everybody? I am Aaron with Sales Jump, and we have here SBCA, Adam and Zach. You guys want to introduce yourself and what SBCA is?
Yeah, sure. SBCA has been around since 2010, helping small business owners from a variety of standpoints, but most of it revolves around startups or existing businesses that are struggling with getting access to capital. And so we use both conventional and unconventional methods to help them through that process. So this really works nice for the pre-revenue businesses that really need to kind of lay the foundation groundwork for not only having options for access to capital now, but then also for future options for capital. So it kind of is one of those things where it just continues to evolve, just like with their business as their business grows. Oddly enough, in most cases, so does their access to capital, which kind of surprises a lot of entrepreneurs. They feel like it's going to be the opposite if they just had, money now. But it basically allows businesses to be able to take revenue, profit sharing earlier by understanding these strategies. So they can really kind of live out their dream with whatever it may be that they're doing, because expanding is one thing. And the only way that you can really start pulling chunks of money out is if you kind of remain stagnant, which is never a good thing. Just depending on what business they're trying to run. But yeah, that an overview is we just really help them with their capitalization strategies. And there's a lot of them and there's a lot of variables inside of those, but we work with people long term. So that's the best way to sum it up in getting them access to money.
Okay, perfect, perfect. And I guess is that what you say your core mission is to give people access to certain levels of capital? Like, when you guys first started in 2010, what was the ideal mission on what you guys were trying to solve for entrepreneurs? Was it just that?
Yeah, it truly was, because most entrepreneurs and business owners are pursuing endless applications like for funding, and they're going down the path where they're just going to get answers of no, no, no. And so I guess really our core mission is that even if you can't get access to capital now, we still want you to know what steps you can take to get access to capital in the future. And then simultaneously, same thing, or if you get access to capital now, what can you do next to be in line to get access to more?
Okay, okay. And I've gotten this question before in terms of what you guys do. So I'll just kind of relay that. But let's just say somebody, that let's just say they can get access to capital, right? Which way, like, how do you guys leverage somebody that already have capital or can get access to it? Do you guys help them find more, or just
Yeah, so take what they have currently, understand what their cash flows look like with regards to coming in through their business. What type of entity are they running that through? And a lot of the long-term stuff is relative to helping them understand proper banking relationships, because if you already have revenue, what you first have to address is what are you getting from that banking relationship? Is it really just one-sided? Meaning, do you now have your deposits going through this bank? So all your gross revenue is going through the bank. And is what you're getting in return just simply a checking account? Because if that's the case, you're banking at the wrong place, right? If you establish it in the beginning, or there's no wrong time to necessarily establish it, but what you should be looking for is a banking relationship where, in exchange for running your deposits through that bank, you now also are working with someone in their commercial banking department. So you know what the benchmarks are. And once I reach these benchmarks, my business will get access to this. Once I hit this next benchmark, my business will now get access to this. And what you're doing is saying, I want access to lines of credit. And even if right now, today, you can't qualify for those, it's best to establish your relationship with the bank where you know exactly when those benchmarks will be hit so that you can get them. Because what typically happens is a business will go in and ask for a business line of credit. and the bank will hand you an application and you fill it out and you get rejected. And they don't really tell you why. One of the main reasons why is that you're asking, in most cases, you're asking for the wrong thing. You're asking for a general business line of credit, which would mean hypothetically you can use it for anything, right? And those are really hard to get because there's nothing tied, there's no security tied to that. Whereas if you knew what you were doing and you were more specific and said, I want to build an actual relationship, which is why it works really well with smaller banks like community banks or credit unions. And you said once we act and you define, I want to use this specifically to buy product or to float POs, right? I need this to float my inventory. I need this for investing in real estate. And you specifically tie it to something that they can latch onto with regards to assets. There's incredible amounts of variables that come into play in that case, depending on an individual's financial situation, both on the business and personal side. But there's just so many things that can be done to set them up and essentially get more from that banking relationship than just a checking account, because obviously you can go get one of those anywhere. So one of our things is to steer them away from the big national banks, just recognizing that even though they provide conveniences with their online platforms, they're probably never going to get the type of relationship their business needs.
Okay, no, that makes sense. That makes sense. And I guess this is almost a question. When you were speaking, you were talking business and personal um lines of credit. When someone like first start working with do you guys first start with their personal, or you leverage their business credit? Which one? Like, how does that work?
Yeah, so it becomes relative to their situation, but the lowest hanging fruit for the average person to get access to any type of money quickly is going to be based on the merits of their personal credit, unless they have years worth of business tax returns and years worth of bank statements. That primarily is going to determine a business's credit worthiness, like whether or not a business is going to be granted access to money without anyone being a guarantor for it. But typically it's kind of a chicken before the egg situation, where typically most businesses that we end up working with, I would say over 80% don't have 2 or 3 years worth of business tax returns. There are definitely some that do, though. So we basically take it from wherever they're at currently. And if it's someone that is ground level just looking to get something started, we're going to now get unconventional and say, okay, well, you're brand new, right? You're a brand new business. What we need to do is, oddly enough, the banks are offering 0% interest on credit cards all the time. Like, I thought at some point they would stop offering it, but they continue to do it. I've been instructing people on how to take advantage of that for over 20 years. And that is, banks are willing to give you access to 0% money through credit cards because they know exactly how that program is going to work out for them in the long run. You're more than likely going to use it to make consumer purchases. You're not going to pay it back before the 0% interest rates go away. And they're going to start collecting their high interest that they charge through their credit card programs, typically over 20%. And statistics to the banks, you are nothing more than a statistic to them, meaning they know the odds are in their favor heavily. So they'll gladly give a consumer access to 0% money, assuming that they're going to go make consumer purchases with it, right? And what we initially tell our clients is, let's take advantage of that fact, the fact that they think you're going to go make consumer purchases. Only let's have the discipline to now use this to fund your business, because this can become one of your best options ever. Is use that, even though they think you're going to do it for personal reasons, use it for the business, because not only does it provide that temporary platform to have access to capital to get a revenue generating business started, but then the really cool part is the act of using it for something that actually makes money. Now that you've used it, and you're now going to have periods of time where a certain level of debt is going to be reported to the credit bureaus because of the fact you're using it to build a business, right? You might end up using a heavy percentage of the available credit to you. And now, from a personal credit profile standpoint, you're now going to turn yourself into more of a rock star than when you started, because if you keep those windows in line with when you have access to it at 0%, you're now going to naturally want to start paying that debt back down as the 0% rates are going away. And what happens is, inevitably, once you've shown higher utilization now versus lower, as you don't want to get stuck with the high interest rates, now you've lined yourself up to get even more the next time. So by paying the debt, by actually showing at one time the debt was high, now it's really low. Now what will change is the next time you go after in pursuit of 0% access, you're going to see your credit limits substantially increase. And that's because they reward high limit credit cards to people that have the highest probability of using them. They're not tracking that they didn't collect high amounts of interest from you, because once again, you're just a statistic, right? They're willing to roll the dice every time and say, even if you successfully did that and paid it off in full, they're looking at it and saying, well, you're not going to be able to do it again. And so who they'll now give that to, if they have a credit history of showing, hey, on these $10,000 limit cards I got, there were periods of time where these were up to like 8,000-9,000 because I needed to use it for my business. And now they got them paid back down lower. Well, that's a perfect candidate for the bank to say, well, wow, on their $10,000 limit cards, they used 80 or 90% of it. So if we give them a 20 or 30 or $40,000 limit, will they now use that? So it's kind of a never ending cycle. If you now take the 20, 30, $40,000 limit card, you do the same thing and use it again, you essentially, within a few of those cycles, those windows of time at 0%, you genuinely can turn yourself into a rock star, where what may take 4 or 5 cards to get you to, $50,000 in access, now you're getting $50,000 limits on your cards, if that makes sense.
Us.
So it's the act of using it that's going to dictate how big will my credit limits become. So one of the things that we walk our clients through is not just how, not because when we get them the cards, we actually submit applications on their behalf, because there is a science behind it. There's an order in which those applications should be submitted
Okay.
to ensure that they get access to the most money at one time as possible. And now that they actually have access to it, we're going to consult with them so that they know exactly how they could or could not use the credit, and what the temporary ramifications are, and then what the upside long-term benefits are, by playing what I call the credit card game. And that is, if you play your cards right in this scenario, you can always have access to 0% money. You just have to know exactly what to do. And it's really relatively simple.
That's I didn't even know that. That's really interesting. I wow. Yeah, we need to have another conversation beyond this. It's you and I don't about that.
Yeah.
But so as far as 0%, can you explain that a little bit further? That funding option and why that's a good choice for people right now.
Yeah. It's a great choice, just because you're never going to get a better deal than that, 0%. So our criteria here is never have someone submit an application to a 0% offer unless they're offering it for at least 12 months. That's the minimum requirement. Some banks right now are offering it out as long as 21 months. A lot of them are kind of in that middle range of 18 months. But the reason we use that 12-month window as kind of the guideline is we know that that gives someone a decent amount of time to use it at 0%, and it makes it realistic that it's very possible that that money that's being used for the business can now come back in the form of profit, and bring that profit back in to start paying down the money that they used from the cards. And that 12-month window of time gives them enough of that cushion to be able to successfully do that, versus like a 3 or 6 month window.
No, okay, no, that makes sense. So even in terms of like getting 0%, is and I think we had this conversation before where you were telling me it doesn't really go solely off of your actual credit score, but the other variables within that. what I guess what I'm asking is what type of credit profile, are people looking for to get that 0% for 18 months or maybe 24 months?
Yeah. So everyone that usually has, 650, 680 in that range or higher, they're typically always going to be getting access to something like some amount. And where it changes as far as the variable on how big or how much they get access to is relative to their credit profile, which means similar to what we were just talking about, it's going to a big indicator is going to be, well, how have you used unsecured credit in the past? Because credit cards are in that category of unsecured credit, right? So it's a different world than even if you've been perfect on auto loans, mortgages. What the banks are really looking for is how have you used unsecured credit in the past? Because what's weird about the credit scoring system is you could have two people, right? You could have two people that both have the exact same score. So let's use an 800 score as an example. Two people with an 800 credit score, the odd thing about how they got there could be drastically different, right? And so you kind of you kind of have to step back and look at the credit score itself and say, well, technically that's an arbitrary number because it can only get so high. The credit score can only get so high and it can only get so low. So no matter what I do, it can only get so high and it can only get so low, right? So the ultimate indicator of what someone gets is going to be how have you used it? Same thing applies to other credit tied more to assets, but in the unsecured credit category, if there was two people with an 800 score and we took them through the process, the funding process, one of them might get double or triple what the other person gets. And that's because you may have got to that 800 score by never using more than 20% of the credit available to you, which could definitely dictate that your score is at an 800, right? But over time, if that other person had used at periods of time high amounts of credit, but then successfully paid it back down, well, that same credit score, they're going to want to give that person based on that credit utilization history. They're going to want to give them way higher limits on their cards because they look at it and say, well, this person that never uses more than 20%, why would we give them a $20,000 or $30,000 card if they're only going to use 20% of it? If they look at the other person and see that there was a period of time that, hey, they once used this, they maxed this card out, that's who they want to give the high limit card to because they have the highest probability of using it. So the cool thing about part of our service and advising people is, and Zach even has personal experience with this, is you can almost build your profile to the rock star status just by simply at least showing to the credit bureaus that at one time your debt was really high and now it's really low, right? And there's a lot of creative ways to do that. You don't want to get crazy and just frivolously go out and spend money, but but you can use it in a way where it can look like it was being used high. They don't know the difference if it was a purchase, if it was an investment, how it was done. It just now gets reported that it once was being utilized at a high percentage. And that inevitably will make your profile skyrocket as far as what your credit limits can become as a result of that.
Interesting. So, I mean, maybe I'm shooting in the dark here, but so what I'm hearing is a good thing to do about 80, 90% maybe on your credit card.
It def it definitely is if you have a plan. If you feel comfortable and you know, hey, I'm doing this, I'm confident I can pay it back. I would never tell someone that's using credit as a consumer. I would never say, hey, it's a good thing to go max out your card. However, if you're a business, if you need to max it out because you need access to the capital, you're now going to be rewarded at a much higher level. And so sometimes it's something as simple as what, and that's because a lot of my client base comes from the real estate investing side of things too. So when they get access to credit, they need to convert it into cash, right? So some of the creative ways to do that would show on the credit report that the debt is really high and it looks like it's a purchase, but they've actually now retained the cash, right? So in those cases, they know it's not a matter of if, it's a matter of when the money's coming back. So if they take that cash and make an investment, But then at the same, I mean, that's now going to be coming back to them, and they're going to be simultaneously building the credit history, right? Of having periods of time where it once was really high and now it's really low. And that's going to put that person in a position to continue to do it over and over and over again. So what you have to be comfortable with during that period of time where the debt is high, and Zach has experienced this firsthand as one of our employees, when the debt's really high, you're going to see a swing in your credit score, because while the unsecured debt is being reported as being high, they temporarily want to punish you and not have you be able to get access to more unsecured credit when that much debt's being reported. And then on the flip side of that, once you pay it back, you bring that money back in, you pay it back. Now your credit profile will never have been better. Because what stays on a credit report on a credit card is it shows the date it was open. It shows what the current credit limit is and what the current balance is. And then the most important thing is, what is the highest the balance has ever been? Those 4 items stick on the credit report forever. And so the variables that would change would be, okay, if the bank increased your credit limit, that's now going to change, right? If your debt increases, that's going to change, or if it decreases, that's going to change. But the date it was open and the highest the balance has ever been, right? Those stay on there forever. So you want to be able to understand why those things are being reported. And then again, as you're playing the game, the credit game, take advantage of that. If you now understand how things get reported, what gets reported, now you can really take advantage of it to be heavily in your favor.
Yeah, I've that's an eye opener for me. I'm gonna be honest that I was always told the other way, don't go to, but that makes complete sense. Okay.
Yeah. So let me clarify that and say, if what you're looking for is to flatline your credit and keep your credit at the exact same level, then the formula for that would be to not use more. Don't use more than 20%, 30% of the available credit to you. So you have to time things correctly when you're using unsecured credit. You have to be comfortable and have periods of time. And it's something that takes a little, where because you're now utilizing it so high, that means that as long as it's being reported that high, your scores are going to go down so that you're prevented from getting more available credit when that much credit is being used. And then the reverse happens when, if you now pay that off, now forever on your credit report, it's going to always show this is the highest the balance has ever been, right? And by strategically doing that, that's the path for getting the high limit cards. Is they once were high, now they're low. So what I like to do, I'll just use examples. What I like to do is, when I get access to new 0% money, I want to maximize that as much as I possibly can. And I've been through more what I call rounds of funding, which is the cycle that you have access to 0% money. That's a round of funding. You'll have 12 to 21 months to use it. More of those than I could ever count, right? When I have access to it, though, every time, because I want to use that money to make money, I'm going to show right upon those new accounts being open, I'm going to show that there's a huge percentage of it being utilized, right? That's because I want to use that money to make money. So I'm going to use all the money that's available, and I'm going to be okay with the fact that while I'm doing that, my credit score is going to drop, right? Because they're looking at that going, man, you're potentially a high risk person that might be on the path for bankruptcy, because you're using 90% of the unsecured credit available to you, which means the scores are going to go down. But I already know exactly what happens. The luxury I have is that I've seen those cycles so many times. I know once I pay it back down, then not only will the score return to where it started, right, the credit score, but now they're just adding more history of, I used this one time at a very high level. Now I'm not using it at all. So there's two variables there, 2 factors. The first one is I wanted to maximize the use of money while I had it at 0%, right? And so I was comfortable essentially maxing out the available credit because I knew that I wanted to use it to make money, right? So I had to be comfortable with that happening. And then also, once I've now used it and paid it off, now it's the perfect time to enter the next cycle, because now you look even stronger to go apply again, and you're going to get much higher credit limits, right? But then you've also got the cards that you now once used that were really high. Now they're charging interest, and you've now paid those off in full. The things that we've been taught as consumers and how to use credit don't really apply the same when you're using it to fund businesses, right? Because you have to get creative and be willing to play the game. So now on those other cards, you do what I call leaving a card dormant. Now that they're no longer offering 0%, instead of making charges on them each month and paying them off, because you could obviously do that as well if you wanted to, right? To earn some reward points or whatever you may want to do. Now, if you purposely and strategically don't make any charges on them, what that does to banks is it drives them nuts that they see one time you were using a large amount, now you're using zero. And it's the perfect opportunity for them to just naturally want you to use that account again. And their best metric, they know that this works for them the best. The best way to entice you to use it again is to give you an offer that you can't refuse. So what they typically do is they'll start mailing you blank checks. And with those blank checks, they'll say, here is another opportunity for you to use 0%. If you use this check, you'll get 0% again for 12 months by using this actual blank check, right? Because they know, see, I have actually been worried that they would stop offering 0%. And over 20 years, all they've done is extended it. Where in the beginning it was like 6 months, now they're up to 21 months. And they know that it doesn't matter how long they offer it, just by giving an average consumer more time, it's not going to hurt the bank. They know that the odds are still in their favor, right? No matter how long we offer you 0%, you're going more than likely to end up having to pay us interest.
Yeah. And they're banking on that, I'm assuming.
Yes.
Wow.
Exactly.
Okay. All right. All right. Interesting.
So if you
So,
look at it from that standpoint as a game, if you look at
yeah.
it like I'm playing this credit game, you can really do some amazing things by just viewing it like, hey, I now understand why banks offer 0%. They do it to try to trap people into debt. And I'm going to now use that to my advantage. They can think all they want to. I'm using this for debt. I'm using it for debt. And trust me, they have plenty of people doing it, because even though I've taught thousands of people how to use it this way, for every one person that we teach, there's thousands that are using it the way they want it to be used. So we don't have to worry and panic. Hey, we're going to teach too many people. It's like, no, this has worked for the bank for a really long time. And if anything, they're just going to continue to offer it for a longer period of time.
Interesting. Interesting. I know you were speaking on Zach. You said him personally. I mean, yourself as well, Adam. But can you guys, share a story, of a client that you had and how SBCA helped their business grow?
Sure. Yeah. There's always different clients that stick in my mind. Like, we can give you lists of people weekly that are going through successfully through that round of funding, and they're getting access to anywhere between 20,000 to 150,000, and that would be considered their first round of funding. So there's endless amounts of those. I would probably say on average there's at least 100 new clients going through their first round of funding each week with our company. So there's endless amounts of people going through and having success at that, at that first level, kind of referring to it as phase one, round one of funding. The ones that stick in my mind, though, that are my favorites are the ones that, even though they appreciated that first round, right? A guy named Edward, he went through that. He was very reluctant, and those are my favorite clients. He was very reluctant to go through because he was just going, I don't understand why you'd use credit cards. And he had an online business where he was selling product. And his problem is it was never ending, that he needed more inventory. So even though he had success, every time he sold 100 products, he knew that he needed to now order 300 more to keep and wanted to increase sales, right? So by most people's standards, he was already incredibly successful at that part. But by just listening and being willing to say, hey, let's just go through phase one, he got 158,000 through the 0% credit card strategy, round one. And he now used that to purchase his inventory. So each card had it for at least 12 months. And what it did for him is it instantly made him feel more relaxed that when his gross sales numbers came in, he he was now able to realize, okay, this is how much I profited. I still owe this much on the debt that he was accumulating on his cards, but he was able to pencil it out better in his mind. I now can buy 3,000 products because I have the 0% money I can use to do it, right? So now he could increase his marketing. He could increase and he could realize each of these products that I'm selling, I'm making this profit. Whereas before, he was having a hard time with it because he was saying, I'm making sales, I'm technically making money, but I'm not able to realize it because I need to keep buying more product, right, for the future. And what was really cool about him is that he was so reluctant in doing it. And then once he started to catch the vision of it, that's usually when clients come back and say, okay, this phase one is working for me. What can I do for phase two? So after after about 2 months of him using the credit and realizing this is amazing, like what I'm able to accomplish by having access to this money, he then came back and said, I want to talk to your consulting department. I want to know what I can do next. And that's when we worked with him on the banking side. And at the time, he was banking with Wells Fargo. And again, I'm not trying to put any bad names out there, but basically, what I had to explain to him was you're never ultimately going to be treated the way you need to be treated at a big, giant bank, the nationwide banks. Let's get you working with a community bank. And by now taking the gross revenues and the deposits and setting up that depository relationship, he was able to start with a business line of credit. Now, in these cases, this is now going to have interest associated to it, right? But he was able to get a business bank line of credit for 500K to start, so that now if he was tapped out on his 0% money, he knew he had that cushion to use that money to now also float more inventory. So if he wanted to increase marketing, increase inventory, he was now able to use that bank line of credit and factor in the interest rate. And then most importantly is that now has grown from 500K where it started on his business line of credit to now his line of credit is 3 million that he has at the bank. And so each thing is done in progression, right? Everything is done just like the credit card limits start out in most cases relatively small, and then this is what I need to do to get them to grow. The same thing happens with any line of credit. Once you have your foot in the door and you start using it, you are going to be rewarded. You're going to be positioning yourself to have access to even more. And that in turn allowed him on just one of his product lines, like just one simple product that he had that he was selling online through his online store, and then all the different platforms that were out there that were making it available for his product to be sold. He took one product that he was selling roughly 100 a day, and then that one particular product, he started selling 3,000 of them a day. And as he explained, that could have never happened. That could have never happened without access to money.
That's interesting. And Adam, you said that now I'm hearing it more often. The first round, second round, and it almost to me sounds like case by case. But is there a certain time frame where you get your first round of funding and then you go for the second round?
Yeah. So first round would be the very first time that we take you through applications, and that once we know exactly what all the approvals were and you now receive the cards in hand, that would define the first round, which means you have at least 12 months to now use that money, right? And then as the window is closing on the 12 months, then what we're going to be telling you to do is now strategically pay each card back down under 30% total utilization. You don't have to pay it to zero, but get each card now paid back down under 30% total utilization, so that as the window is closing on the 0% from the first round, now you're perfectly positioned to execute round two of funding. And our trigger point is once we see that the debt was once used at a reasonable ratio, like let's say over 50%, now it's back down to being used under 30%, and the 0% rates are going away. It's the perfect time to now execute round two of funding, because we already know that just from the act of using the money of once being over 50% and now being back under 30%, we know that that's the perfect storm to then not only open up a new window of time at 0%, but now you're going to see whatever your results were from the first round, you're going to see those results at a minimum double, if not triple or quadruple.
Wow. 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 Okay. All right. So let's just, because I'm sure there's a lot of people that's going to hear this, and they're, everybody just want to see if the water's cold or not. All right. Or if it's warm. So let's just say for people that want to get into this, want to secure business credit or funding, um, just for not a certain specific, profile, what would you say are common hurdles people see when trying to, do this?
Yeah, so if their credit scores are low, we just look at why they're low. I mean, all of them can come in and get pre-qualified without it showing as an inquiry on their credit. We can run a pre-qualification without it showing as an inquiry, so we can always assess someone's situation. But if your credit is under 650, more than likely you're not going to qualify. The other hurdle could be if why it's at 650 is because you're currently maxed out on all credit cards, then what you're going to want to do is figure out a way, even temporarily, to get that debt paid back down under 30% total utilization. So there's options to even potentially temporarily get a bridge loan, strategically pay the cards down for the sole purpose of now being able to open up access. Because the percentage of your credit utilization can have such a drastic impact on your credit score that if you can find a temporary solution to just simply pay that down, right, to get that debt paid back down, it can swing your credit score by like 100 to 200 points. So we have to evaluate why is their score as low as it is, right? But again, to illustrate an example, because I can share over and over again on my personal side, if I'm ever getting ready for a round of funding to submit applications to get access to new 0% money, I'm going to get my debts paid back down to where I know my score is going to be in the 800s, right? Once I get it, and now I'm going to pretty much max it out every time, just being honest, I'm going to max out every time. Now I'm going to expect my score to drop possibly into the high 600s. That's how much of an impact it has on the total percentage I'm utilizing. And I'm okay with that, because while it's low, I'm just using that money to make money. And then I know it's a rinse and repeat, and now there's a new cycle to begin. It's also the perfect time to talk about, now, how does this impact, like if I'm someone that already has a business entity and I'm under somewhat of a delusion that I want to get all this access to money under my business name, right? So the way it works on cards in a business name is still 95% of the decision is going to be based on the merits of someone's personal credit, right? So in order for my business to get access to unsecured credit in the business name, I still have to have a good personal profile, so that, because it's unsecured credit, and so they're going to want to see that someone for the business is essentially co-signing, right? I'm willing to put my personal credit on the line so my business can get access. What will happen is their personal profile, if it's strong, their business will get access to money under the business name, right? And then the thing that everyone's looking for that they think is really cool is that now that it's under the business name, if you max that out under the business name, the existence of that debt does not show up on your personal credit. Okay. But what I want to point out, so that's what was really cool, and people misinterpret that all the time, and they think, well, this is really business credit because now the existence of this debt does not show up on my personal side, which is really cool. But, and it is cool, but there's always catches, there's always a good and a bad side to it. If that's what you did the very first time, and now your business is using the credit, the 0% money, and you're looking for that temporary reprieve to not have the debt show up under the personal name, now forever, you're also going to be missing out on the fact that it's not being reported, right? The fact that it's not being reported means that you could use that credit under your business name, pay it off, and no record of that is going to count towards your future. So the problem that you run into with that, and it's not true business credit either, because if you miss payments, it would come back and hurt you personally, right? You can't walk away from it, but it confuses people because they don't see it getting reported. So they automatically assume that it's real business credit, but it's not. And the way that every client should look at that is that you, once again, using it as a tool, because it's really cool. It doesn't show up. However, if you don't build your personal side, if you're not willing to use your personal side to get to the point where you have credit limits that are 50,000 plus under your personal name, then technically your business is never going to get those types of limits either, no matter how successful your business is, because they're going to ask you to be a guarantor every time. So if you sign up and they now pull your credit and they see you've never used more than 20% of your credit, your limits will stay exactly the same. Does that make sense?
It does. It does. So would you give that advice to, I guess, small business owners to leverage their credit and then move it over? Is that a common practice? Yeah.
Yeah. So if we take someone through and they already have a business entity, we can get them access to 0% money in both the business name and personal name. And what I recommend is start or originate the debt on the personal side, because one of the cool strategies that can be implemented right away is, let's say you got 50,000 in your personal name, 50,000 in the business name, right? Well, if you only need to use 30 or 40,000, but you have access to 100, and that's your scenario, that 50 of it's in the business name, 50 of it's in the personal, first originate those purchases, whatever you may need to use the money for investing, originate them on the personal side, right? Let it actually report to the credit bureaus that much credit's being utilized, then transfer the debt over to the business side. Now the business side will not be reporting, and so you'll see that swing in your credit, but you won't miss out on that opportunity, because it never matters to them what the debt once was. All that matters is what is it right now, right? And then, so if you showed that it once was high by making those purchases under the personal side, and now it's been transferred over to the business side, you really get the best of both worlds in that case. So let me give you an example of that, because as I struggled to figure all this out, I was getting cards in the business name, maxing them out, paying them off, right? But those don't get reported anywhere. So again, that's a bonus that it doesn't get reported anywhere. And it also hurts you that it doesn't get reported anywhere, because each time I now went in to get more business cards, they kept my limit exactly the same, because I was doing nothing on the personal side. And so if my average limit was 10,000, I kept applying for business cards and the same limit was being given to me. And it was only when I realized I first need to turn myself into a rock star. I have to turn my personal credit profile into rock star status to get the high limit cards for my business, right? And then and only then. And so what I really started to realize is, so really business credit on the unsecured credit card side, it's really more of a vehicle to get access to more money than it is to ever think of as a way to eliminate liability or even build what people label as business credit. Because technically, since they make you act as the guarantor, they don't report that to the business credit reporting bureaus because they know they have that safety net that if you don't pay, they're going to come after you personally, right? So therefore, you're actually hurting yourself by not having periods of time where you're using it under your personal side and then paying it off because that history of utilization is going to basically go into the ethos and not benefit you in any way.
I see. Wow. That makes a lot of sense. Wow.
So you just have to be
I
willing to
got my
once again
pen.
to
I'm
go
like
in.
taking notes right now. I mean, I'm like, that's, I didn't know that. I said, I didn't know. You don't know what you don't know, right? Oh, man.
Yeah.
That's interesting. That is really interesting. Okay. So, as far as, what you guys do here at SBCA, what future plans do you guys have for, current or people that's looking to, work with you guys?
Yeah. So our plans, I mean, that we don't reinvent the wheel when something's working so well. So we're always going to have that 0% interest side. And we're always going to recommend people to do that. And then we assess what else they potentially would want to do. So we have the service that we can help them through the whole banking side. We can even act on their behalf and reach out to banks and start connecting them to the right person at the bank
Hmm.
to get those banking relationships as strong as they possibly can be. Um, but we're always working and looking at new avenues. It's just that the one thing that, as far as reinventing the wheel, we're never going, no way possible to get 0% unless it's through that temporary credit card strategy. So we're always going to have that in play as long as the banks. And again, there's been times that I thought it's going to go away, it's going to go away, but the reality is consumers are falling into those traps. They're using it the wrong way, which means the banks are going to continue to offer it, right? So we have that to our advantage. Um, so we're always going to look at that. We're always going to look at if they want to evolve getting into the business lines of credit that will have interest associated, but can still be a very, very powerful tool. And then we're always keeping up to date on what different banks are doing. And so in the future right now, from a technology standpoint, some of the things that are being built out are ways to target specific banks in their area. And the main reason for that is that some that are offering pretty good deals on 0% and for this long through their credit card programs, that's not a universal thing. It might be a regional bank in their area. And so we're building out the technology to track that so that we can offer that as an option for someone to say, as part of the finalized round of funding, hey, this particular bank, because it's in your area, let's have you just go in directly and make sure the timing's right and get a card from them as well. And that's not necessarily going to change that much other than a round that we went through. We're going to now be adding more available money because that's one thing that I think we get more than anything else is that a client will go through and they'll not understand why are you guys pushing it? Why are you trying to get me so much? And that's because we know that inquiries are going to result no matter what. There's going to be inquiries that hit. So let's get access to the most money possible because never, ever have we had a client say, hey, you know what my problem is? I have access to way too much 0% money, right? But we have had them unknowingly or being stubborn say, I only want you to get me 20,000. That's all I want you to help me get. So we abide by that, even though I cringe every time that someone says that we've agreed to do that. We only get them 20, and then it's inevitable that they come back in 3 months and say, how do I get more? I need more. So our general standard is if we get you 150,000 or if we get you 30,000, it's not going to change what you end up paying us. Like there's no difference in the fee structure. Let's try to get you as much as we possibly can. So those are things we're trying to add on is to just ensure that we're getting someone access to as much money as possible at one time.
Perfect. Wow. So, like we said earlier, you said, it's the play the credit card game, and if you play your cards right
Oh
and
yeah.
intended, it works out for you, right? Um,
Yeah.
uh, I love it. I love it. Okay, that is that's a lot right there. I'll be honest. Some things you said, I really felt almost. stupid for a minute and inadequate. I was like, I just didn't know that at all. Like I didn't, I
Yeah.
wanted to go out and like go tell my wife, just come here real quick. Well, listen to what he just said. That's it's interesting. Wow. Okay. All right. So Adam, Zach, for somebody that's listened to this and they're like, you know what, I I I have an existing business, or I want to start a business and I have a pretty decent credit profile and I would love to leverage, you know, something like this to build scale, start something, whatever, their goal is. How can they get in touch with you guys to work with?
Zach, do you want to pull up a link or pop up the best way?
Yeah, let me throw a link in here, but our website is sbcadvisor.com, and they can go straight through a form there. We have a 0% interest funding form, just a general form with the link right on a home page where they can enter their info and get pre-qualified right away. Know whether or not you have to build your credit a little bit more before we can consider you for this, or hey, you've pre-qualified for 30 to 50,000 or whatever it may be. So that's probably the easiest way to do it. They can also call us and we can help walk them through that. But yeah, the information's all on our website, so I can link that, and but pretty straightforward, sbcadvisor.com.
Perfect. Perfect. All right. Again, it was a lot to take in. You know, only way you can eat an elephant is one bite at a time. I felt like I just ate the whole elephant just now. I wasn't ready for that type of information, Adam, but it definitely dropped a lot on me. I don't know. I almost feel like I got a lot to think about. I'm gonna pull up a couple of my. Yeah, I'm gonna start doing things differently. How about that? That's exactly what I'm gonna do
Yeah.
immediately.
Well,
Actually,
it's very true that the statement that you've made that you don't know what you don't know. And the thing is that the banks have us right where they want us. They want us to believe that things can only be used for certain purposes. And it's odd that they're more than willing to say, come take our money and go use it to make, get instant gratification, go take the vacation, go buy the furniture that you want right now. It's just kind of America in general that they've got us exactly where they want us. And both the banks and the credit bureaus have a monopoly. So the reason they have a monopoly over all of us. So the reason I consider it a game is because I'm going to accept that this is the system that there is, and I'm going to use it in a different way. Right.
mm,
Because if I want to use that capital, and even if they think every time I'm using it to make consumer purchases, that's okay. Right. That's what they want.
yeah,
They can think that that's what we're doing, but we're actually using it for things that, investing in businesses to actually make money. Um, it changes everything. It's looking at money from the mindset of an investor versus a consumer or a spender or even a saver. In fact, those kind of money mindsets are my favorite when I figure out like what phase they're in. And the sole goal is to get them into that investor mindset when how they look at money. Let's show you how other people do it. They use other people's money to make them money, right? Even if you have a bunch of money, you use that as leverage to get access to even more of other people's money. So those are fun things to be able to teach and to strategize so that people can really understand how the consumer credit system works and how they can take advantage of it to actually use it from a different mindset, the mindset of an investor.
interesting. Interesting. All right. Well, for those that are listening, um, I'll actually put a link down so you guys can, directly get to the SBCA website. So you can talk to either Zach or Adam or one of the representatives there. But I I don't know, I almost felt like I just took a course. I took a quick Udemy course, so I so it was worth the money though. I tell you that it was worth the money. But I enjoyed learning a lot. I did, and I hope you guys did too. Zach, Adam, anything you guys would like to leave everybody with before we head out?
No, we're just willing to teach anyone that wants to learn, and all the intricacies. That there's quite a few variables, but we're very patient. We'll teach you all the variables. Like, people get confused by something as simple as, well, I use my Amex card every month and then I pay it off. Why am I not getting a good credit history for that? And that's because that's really just internal credit. That's internal with Amex. It's not being broadcast because you're having to pay it off each month, right? So unfortunately, you're not getting the kind of credit history you want to get, because before that can ever even hit the credit bureaus, it's already paid off, right? So you're building that internal credit with Amex, which may mean they're going to increase your limit. But if what you want is to play the game with 0%, we'll help you out so that you know exactly how to play the game.
Wow. Let's play the game. Let's use money to make money. That is the slogan
Yeah.
that we have there. All right. Well, it's been a pleasure talking to you, gentlemen, and we'll speak soon. All right.
All right. Sounds good. Thank you. Bye.